everyone. Welcome to yet another episode of Reinventing Finance. Today, we're very happy to have Amélie Breitband, CEO of Lloyds Europe, with us today. Amélie, thank you so much for taking the time. How are you on this fine day?
I'm very well. The summer has been beautiful and with good and bad news, we would say, about how sunny it was, but all good.
Awesome. Tom, how are you today?
Very fine.
Very fine.
Last days of summer, I think it feels like.
It does feel like it. One of the things I need to do is get my winter coats to the dry cleaning. But because there's it's reinventing finance, and if you're kind of on the finance then the insurance, we are of course talking about the Lloyd's insurance marketplace, the oldest insurance. I don't know. I mean, you can basically say. I mean, I know the coffee house. I don't know whether you've invented insurance, but it's not the bank. That's what I wanted to. Amélie, maybe can you briefly introduce yourself to our audience? Who are you and what do you do? And maybe you can also educate me about the history of Lloyd's and insurance.
Of course, and I love to tell the whole story about Lloyd's, but so a bit about me. So I've joined Lloyds Europe a bit more than 1.5 years ago. I live in Brussels because this is where it's based out. I'm French, as you can probably tell, and I spent all my career in insurance. Can you believe that? I started actually in an audit firm and suddenly fell in love with insurance because it's really about enabling people to take more risk. And I spent a few years in consulting firms and also 16 years at AXA, where I've traveled a bit the world. I've been based out in Hong Kong, London, and Paris as well.
So maybe for those in the audience who might not know, could you just briefly, because Lloyd's is a special beast. You cannot buy your motor insurance directly at Lloyd's. So could you just briefly, what does Lloyd's do? What type of customers do they serve? And maybe also what's the difference between, Lloyd's London and Lloyd's Europe?
Yeah, so maybe to start about the history we were mentioning. So I think probably insurance was invented by the Greeks, probably, but Lloyd's made it happen. And so since 1688, you were mentioning the coffee shop of Lloyd's. So indeed, it was a coffee shop in London. And this was a place where he would gather what we were calling by then the names. So the British lords bringing capital. And then you had the ship owners coming over. And some guys who are putting their names on a blackboard where you had the names of the ships, and they were putting their names under the ship, which is then underwriting a policy, so putting your name under the name of a ship, and they were saying, for example, I'm going to take 20% of that cargo. And I think what's quite interesting about it is that it shows that an insurance company can be like AXA or Allianz, like all in once, capital, underwriters, and distribution, or it could be slice and dice into pieces, and that's the Lloyd's market. So if you think about nowadays, and talking first about London, so you have this incredible building in London where so you have the underwriting room, and if you're a customer, you're going to go with your broker, more likely, and it's a market, an exchange place. You're going to cross the floor, and you may have with your broker maybe 5 or 10 quotes on what your risk is. So it's a pretty good way to have a fair price for large risk and unusual risk. I think that what you were mentioning, you wouldn't buy your motor policy. It's really about those very specific risk, which are where you would have a bit of a customized policy. And this is where you can have fair quotes, which, as I was saying, is a bit unusual if you think about the type of risk that we're facing. So then COVID happened, and we had to move to digital, and we probably have the opportunity to rediscuss about this. The underwriting room is still there because as it's insurance is a mix of something which is very technical, and I think we'll have also the opportunity to go back to that, and very relationship based, because basically you're putting almost your future in the hands of your insurer. You're paying a premium, and if something goes wrong, then you hope that you're going to be paid. And because of this, there's this mix of relationship and very technical aspect, which could be managed virtually. And that's what happened. And that's why the Lloyd's market survived throughout those COVID years. And now maybe a bit about this difference between London and Europe. Brussels, the Brussels office was created initially because of Brexit. Because if you think about this London market, the other miracle about it is that by just having an insurance company based out in London, you can have access to the whole world. So we have licenses, because you know that to do insurance, you need to have licenses. It's key to protect the consumers. And usually you need to create an insurance company everywhere where you want to sell insurance. But because we're talking about very large risk, and you need to have cross-border trade, just by being on the London market, you can have access to the whole world through those licenses. And you put some money, if you're a so-called syndicate, in a central fund, so a central pot. And if one of them defaults, then you're going to use the central fund to pay the claim. So after Brexit, this miracle couldn't continue in Europe, and we had to create an insurance company. And I'm the CEO of that insurance company, Lloyds Europe, which then allows both the customers and those insurance companies to continue to do business in Europe. And what happened is that after a couple of years, and we had to settle down and set up various new operating procedures and way of doing business. Now we concentrate on developing the Lloyd's platform in Europe.
I would like to ask an additional question, because what I find so fascinating about Lloyd's is that, let's say, if you zoom out, suddenly in a totally new, let's say, situation in the world, and we're doing this podcast because we'll see each other at the DIA in Munich. We often talk about, let's say, fintech. And then suddenly business models from the past are totally modern again. So on the one hand, you have this old idea of underwriting, etc. And then you had a long time of integrating the whole value chain, let's say the big AXAs and Allianz of this world, if you take in the European context. And then suddenly you have disruption going on. And then it's about slices again and specializing on a certain part of the value chain. But you see the same, for instance, also on the macroeconomic scene, where you have a linear thinking for a long time, and now it comes back to circular, which is very, let's say, let's say in a historical context, it will be Greek or even let's say prehistorian way of thinking. What's this this role of Lloyd's if we also think about fintechs in this new world?
Yes,
How do you see it?
Yeah, I think that Lloyds has always been innovative. So I think they've created the first fire policy. We are well known to have paid claims in San Francisco in the early years of the 20th century. We've created the first D&O policy, and that was just after the 1929 crisis, when boards started to emerge following the various acts that were issued. So we are, and we've created the first cyber policy at the end of the 20th century. So Lloyds has always been known, indeed, as being quite innovative. And by then it was about exploring new areas of risk. So in that sense, fintech is going to be, an insurtech, more precisely, is going to be of the essence. Because on the other hand, if you think about insurance, while at least Lloyds has been very innovative, as a customer, you may feel sometimes that we are still a bit in middle age, and we may have been one of the only industry who has not been Uberized or Amazonized. So and so that's how to jump definitely into the 21st century, and this is where fintech and insurtech can help us.
So maybe that's a decent segue into, if I, what does success look like for you personally? And you can pick a time frame. Let's just say a week, maybe 3 to 5 years time. What would you like to look back on?
Yeah, so the success for me is about increasing the insurance coverage in Europe. If you look at Europe compared to the US, and even in the US, there is what we call a protection gap. So people are not insured up to the level where they should be to protect themselves, to protect their assets, them being tangible or intangible. We can see that we move a lot from tangible, for example, property, to also intangible assets such as the brand, reputation. So if you look back at the floods last year in Europe, in the Netherlands, in Belgium, or in Germany, only 20% of the people were insured. And then, and if you think about ESG, it's about both E and S, because when people, and we can see that after hurricanes, if people cannot recover their assets and go back for individuals or go back to business, then it's a social disaster. So my goal is to have people in Europe better insured. And that's also because if you think about the role of insurance, and we see that there are various layers. So we talk about the customer layer, and then the insurance layer, the reinsurance layer, and then governments, and then supranationals. Especially after COVID, you could say, why should I, get a policy? The government will prevail, but it's not a solution, because at the end of the day, anyway, it's the taxpayer who's going to put some money in. And also, if you increase the number of people who are insured, then you increase the money that insurers can then use to pay back to pay the claims. And also there's another virtue with the insurance, which is prevention. So if you have an insurance policy, you will do everything you can to decrease the level of premium, and you're going to increase all those mitigating measures that you can implement. And we may discuss about, for example, cyber. It's not only like your house and trying to prevent floods from invading your house. So success for me is having this bigger coverage in Europe. And I think that Lloyds can help being additive to the European market, where there's a lack of capacity. And to do this, this is where I see some role with InsurTech in making this happen.
And when you're talking, you've mentioned the flood, 20%. Are there some other specific protection gaps that you think are prevalent other than, let's say, flood risk? What's your top 3 or top 5?
Yeah, so I think, and I'll concentrate on what we call property and casualty, even though, so for example, they could be pension as well in the insurance world, but I'm not going to discuss about those. But in our world, so definitely anything which relates to climate change, because it could be indeed floods or drought. We can see after the summer. So that's there's a number of what we call perils, which are not well insured. So that's climate change. I think it would be 2 to 3 very large risks that are not well covered. Then I would have cyber as another one, and then and pandemic. So these are the top 3 ones. Having said that, even if you look at property, for example, I was told that in Antwerp, for example, they were struggling to find insurers to cover their the new infrastructures that they are building. So even traditional insurance, and we shouldn't underestimate traditional insurance for those kind of infrastructure, because the role of insurers could be about, do you want to build this here? It's close by this to the sea, and do you have the right materials to build it? And also because there's a role for insurers when you have a claim to build back better. start to include those mitigating measures and better materials for the environment. So there are plenty of risks where we are not well covered. And another point I'm going to add to this is that for insurance to work in terms of statistics, you need to have the law of large numbers. And then to apply. Otherwise, the premiums are not well computed and it doesn't work well. So it's if you have everyone having a policy, then this law of large numbers is likely to work better. And then you can really mutualize the risk around everybody. And I would say everybody, not only in your country, but probably in Europe. And I would then enlarge it to the planet and even to the universe, now that we're going to fly to the moon or Mars. It's really this mutualization across the galaxy. I think that works very well.
I have an additional question about those really large risks. I mean, let's say from a historical perspective, at certain times we just have decided as a society just to have certain risks covered. If you take unemployment or whatsoever, what's your opinion about this? Let's say role of a society or let's say politics as a whole? Because I mean, if you would argue that we can only cover these huge risks when you have enough people, having those risks secured, the easiest solution is just to say everybody needs one. So why don't we just decide on that?
Yeah, I think it's a very, very valid question, because this is where so this is what we call the public and private partnership question, which is when should we then deal with a risk using insurance companies, and more likely to be private companies, versus the government. And the way I like to structure the debate is that if you use insurance, it's going to be based on math, because insurance is all about math. So it's the average and then a standard deviation. And as you can see, as a customer, probably there's a bit of your risk which is taken into account, and the rest is shared. So that's what we call mutualization. But it's based on a mathematical way, and a bit of your risk doing the trick on how to share the risk between a given population. If you think about the state, because it's the taxpayer at the end of the day who's going to pay the bill, then it's likely to be more the wealthier than paying. And I think that in terms of politics, it's how to strike the right balance between the two, and probably a bit of both makes sense, because and actually I would say in the Western environment, it's a bit of both. So part being based on the mathematical distribution of risk, and part being around the wealthier paying a bit more of the share. But so there's one aspect which is the political one, and that's how to share the risk. And as I was saying, because of the role of prevention, you need to have insurance, even if your view would be that always the wealthier should pay. Because the thing is, you need to foster this prevention. And if you're only building it on governments, you're not going to foster prevention. Because the premium, so to decrease the premium, then people start, if you think about IT, to build protection. Or if you think about climate change, they will stop building houses in floodable areas. So I think that's where the ideal mix is a bit of both. And also, to be honest, even in a public and private partnership scheme, like what you would have in the UK, what is called a flood re, for example, or even in the US, where we often underestimate the role of the state, or in France, for example, on NatCat, actually it's the insurance companies managing the money that is collected on behalf of the state to then pay the claim. So that's why, and without entering into too many political debates, I think that the best, it's a bit of the best of both worlds that we need to then have this very good dynamic and positive energy about the prevention.
So, Amélie, if you were I hope I pronounced it, a benevolent ruler of Europe, and this was one of your legacy points, solving the protection gap, and to kind of simplify how would you deal with, how would you deal with flood or, climate, the three risks? Which one would you go to Lloyds, or which one would go to AXA and the like? Which one would go to States? Which one would go to partnerships and the like? Just kind of because I get it, but I still don't. I think I get it in theory, but for me, a use case or would be helpful to just listen to you think.
Yeah, and to be honest, I think that's what needs to be done. It's kind of this computation, and it's dealing with data, and then probably it's going to be a good segue to move to more about what fintech and insurtech can do with all of this, because I think that we haven't run enough models to then split between the two. The limit to insurance is what we call systemic risk, because risk to have something which is insurable, you need to have something which is random and independent events. So things which happen randomly, so it's not certain that they're going to happen. If it's certain, I often take the example of bicycle. The cost of insuring a bicycle in some places, in some cities, notably in Europe, is the cost of the bike. Why? Because it's 100% sure that it's going to be stolen. So if a risk is 100% sure to happen, then the premium equals the value of the good, and if it's still random, then it's going to be the probability of it happening times the value of the assets. Actually, insurance is very simple. So where things start to be complex is that if something is happening to everybody at the same time, which was the issue with restaurants, for example, closing, so that cannot be insured. But this is where a public and private partnership can work well, because if you think about the lockdowns, it could have been more, focused to one area and then the other one and then the other one. Where if you have a lockdown everywhere, then it cannot happen, because all of those premiums that we would have gathered would have to be paid back, and they were based probably on a probability that lockdowns would not happen everywhere. So that's something that we need to keep in mind, that it needs to be random. And the other aspect, which is that the events need to be independent from one another, that they don't happen at the same time. And that's the thing about insuring thing at worldwide level, and that's why platforms like Lloyds are critical, that you bring capital from everywhere in the world to cover all the types of events that can happen, on the basis that they are not going to happen all at the same time. And then, so one year it's going to be the US, and then the other year is going to be typhoon in Hong Kong, and then the other year is going to be a windstorm in Europe. But the thing is, with climate change, it's likely that lots of things are going to happen at the same time. So this cut between the partnerships between the insurance companies and governments, it's when to step in when it starts to be more systemic. But still, even something which is systemic can start to be insured at the insurance level, because there's all this money that we collected over time that can be redistributed to everybody. So I think that's one aspect. The second aspect is also in prevention, that I've mentioned many times already. And I don't want to seem too gloomy, but if you think about some of the shores, I'm thinking about Europe. So in the Netherlands, Tom, I'm afraid to say that it's going to happen. It's not about if, it's about when. And then you can start moving people around and probably then telling them you shouldn't be on those places, and then starting to have a plan. Because if you think again about the S in the ESG, it's about moving people in a soft manner, having plans, to do so that it's not too disruptive when it happens, and you have migration everywhere in a very chaotic manner. So about your point, Nick, on where to draw the line, this is where we all need to work together to think about what makes sense and for which type of risk. And then we can start planning. I think if we look at the pandemic, it was just about nobody had planned for that. And it was in all of our scenarios in the insurance companies that it would happen at some point. So, but it's not to be gloomy. It's about being optimistic about the future and making sure that our children will have a bright future.
But what I would like to add is that let's say if you just take Germany as an example, you take Bismarck, and if you see the speed with Bismarck, let's say invented a lot of insurances and stabilized the kind of, let's say, fundament, which from let's say this point of view at this time we would call this civilized. So I mean we don't have a lot of time. What I really don't understand as an entrepreneur, I'm not working for the state. What I don't understand is why these huge corporations don't ask the let's say politics to go much faster. So if you take, for instance, the risk of people who are not insured, you can solve it very easily, like we solved all these other topics in the past, just by saying it's obligatory. So if you just would say, okay, we already know from statistics which parts of countries will be flooded or rivers, etc. You just say, okay, if you buy a house or if you have a house, you need an insurance. Like if you want to drive a car, you need an insurance. We would call having an insurance for driving a car civilized. We would call being obligatory unemployment premiums, we'd call the civilized. Why don't we just, let's say, ask as, let's say, huge corporations like AXA and Munich Re and Lloyds, etc. Why don't we just, okay, if we want to solve this, if we really want to solve this for the future, just don't wait for the next floods to be happen. Solve this with a systematic approach.
Yeah, absolutely. And the thing is, so you say, like, why don't they go to the they being the insurers and insurance companies? So because as Lloyds and we are a marketplace, so I often compare us to Airbnb. So we are not the landowner, the people, you know, like owning the houses in Airbnb, and we are not renting the houses. We are the market. So and because of this, the nice thing is that I'm kind of agnostic to which insurance company. So then it gives me some probably more freedom to then have access to the notably the European guys, because it's where I'm based out and in Brussels. So the MEPs and the Commission, and we are starting to have this conversation. And that's why the fact that now we have those operations in Europe is helpful, I think. And because as a marketplace, we can be probably more influential than individual companies. And we are trying to then find what I call allies to then start this discussion. And if you think about 2024, which is going to be the new commission, it's almost tomorrow from a political standpoint. And we want to have this debate. To be honest, if you think about politicians just after COVID and where they are just after COVID, all those disasters, it's a difficult decision to take this decision to make it mandatory. So I'm just putting myself in their shoes. I don't want to say it's easy, but to be honest, and I'm a bit biased because I'm working for the insurance sector, I would have all of this being mandatory. But then also you could say, well, it's mandatory for those who can afford it and maybe not for others. But then where to draw the line, it's going to be another question, because there's always a bit of a cliff effect. But it's all about, and that's precisely what we are doing, trying to raise those questions. And I mean, as Lloyds, we talk about those very large risks, and then, but it could be the same for other types of risk. But definitely, that's on our agenda, and this is where, to go back to your question, what success would look like, is that we've been influential enough to change that.
Yeah, I mean, time will tell, but I think it seems obvious that, you know, it's exactly one form of solution of the big risks is you need to make part of it mandatory, in still adequate, have some form of risk pricing in there, that someone who buys, you know, their house at the Rhine rather than, or in Hamburg or someplace else, has a higher premium. That is just part of, you know, having that property. It's priced in. You'll then have some form of public excess of loss protection, so the private markets can place. And then, similar to some of these kind of pension schemes in the Scandies, you'll have insurance companies bidding for underwriting and managing that risk, right? And I feel, let's see, with so much proverbial shit hitting the fan, that there is a change in mindset in us as citizens, whereby we previously just didn't want more state. I think there's, I mean, at the end of the day, I'm a firm believer that in a democratic process, we as citizens get exactly the type of politicians we deserve. And, I think we're looking for different, not even different solutions.
Yeah. And anyway, us as policyholders or taxpayers, it's the same human beings. It's us. So,
Exactly.
So it's just about how the risk is shared. And I think that, so of course, in the insurance sector, we talk about mutualization, which is a technical word for sharing risk. And as you highlighted, it depends on where your house is built. So you have a bit of skin in the game. And still the rest is mutualized. So because it could be about bad luck. So there's your own luck and how you influence your own luck because you choose where to build your house. And that's your skin in the game. And then the other part is there's bad luck. There was a storm and it was more near the Rhine and rather than Hamburg. And then that one is supported by everyone. And so that's I think the way we should look at things. But yeah, at the end of the day, so it's almost moving from mutualization to what I would call solidarity, and which has a more, so you move from math, as I was saying, to something which is more political, and where to draw the line. So I have my own views, but I'm not here to express them. But I think it's in the ideal world, it's a bit of both. And as we were saying, either we are citizens and taxpayers, or we are policyholders. So at the end of the day, we just share the same risk and the same planet.
And I think this is really interesting, because I was thinking about how I got an answer now. We still, obviously need to get it through the political process, and let's see how that happens. But kind of just conscious of time, and I feel that would love to a little bit understand about your digital transformation process. I think you call it blueprint. Of course, you have a lab, but could you just kindly explain in your own word, what does digital transformation mean for Lloyds as a marketplace, and where do you focus, and then maybe what are some more, some shiny objects, some flagship developments from the Lloyds lab?
Yeah, so to achieve that goal of then having more insurance everywhere, it's about making it easy to deal with. And even if you're not so an individual and on the retail side, even for large corporates, it's about how to make it easier. And we started this conversation by explaining how the market was working, and that it used to be a very physical market with those people meeting and hugging at the Lloyd's coffee shop. And because of COVID, and it started to be more virtual, but it's still not 100% digital. And for marketplace, and we've seen the success of all the marketplaces, and I was mentioning Airbnb, or you can think about all the other ones. It's about then making sure that supply meets demand. And we are talking for platforms about sites. So you have different sites. So if I think about LinkedIn, you would have us as individuals and with our professional lives, and then you have the recruitment, the recruiters, and you have the advertisers, and they're all different sites, and then they meet on a platform. And the digital aspect is how to accelerate those meeting points. And so if you think about insurance, it's about, there are people who need to cover their risk, and there are people covering them, and brokers in between. So, and I think that it's not about disintermediating. So it's not about getting rid of brokers, not at all, because I think that they still have a key role in pricing and in prevention, for example. But it's how to make sure that this marketplace and the exchange side of the marketplace, which is about having people meeting together and those needs being met, this is where digitalization is absolutely key for our market. And this is where we can still, you can have all the processes, and we've reached that level, which are most of them digitalized, but it's how to have the last piece, which is, for example, you're a customer and you say, here are my needs, and then you would have digitally, you would making sure that this would meet then the capacity from the market. And so where there are things, and part of the successes of the lab. So first, there's a lot about AI in this, because there's pricing, and so I've mentioned math a lot of times in my conversation. So insurance is a lot about math. So artificial intelligence and is absolutely key, and machine learning, because you have more and more data, and then you can price in a better way, which is win-win for everyone. So that's one aspect. Also, in those very large risk in this community, you share risk all the time. So you don't have like just one insurer. You would have a leader and you have followers. So for example, you have Key, who's a syndicate of Brit, and it's all based on algorithm. How you would, the leader has takes the risk and prices it, and then the followers can adapt. So that's another way, another place where fintech are really useful. It's because with artificial intelligence and machine learning, you can improve the way you price things, and all of this every time is allowing to have demand meeting supply in a better way. And then some of the more sexy stuff, because you would probably, and if you compare to other industries, the role of tech is not so visible for the customers. But so, and you wouldn't see this the role of machine learning in premiums pricing. It's not something that you can see. So it doesn't seem to be very sexy, but it's pretty cool actually. But in things that can be seen as pretty cool. So you would have, and that was part of the lab, drones to look at some of the sites. So when there's an explosion, for example, or there's fires, you can use drones to assess the risk where people are, and still have a bit of prevention, because even if the event has happened, you can prevent the damage to be even bigger. There's also Parcel, for example, which was created just after COVID, and it was about gathering and sharing data so that the vaccine transportation would be easier. There's a lot around crop insurance, and you know that we are going more and more towards what we call parametrics. Parametrics, that's if you compare to traditional insurance, in insurance you have an event and then you have damage, and that damage can be more or less significant. With parametrics, you would just look at whether the event happens, which then makes it very easy to pay claims, because you don't have to figure out whether you had the damage. So if I take Roland Garros, for example, like the tennis championship, whether it rains and you had to stop the game and you have some business interruption, then it's just a matter of how much rain actually comes in, and you wouldn't look at whether there was actually business interruption, whether or not the game was stopped or not, and whether there was a loss. So if you think about crop insurance, for example, there's a lot about parametrics. So whether there was wind or storm or thunder, and all those things are based on how to measure those parameters. And so the lab has been very helpful in this. And the way it works is that we have cohorts, and they spend some time, and that was the London aspect of things, and we can discuss about the European one a bit later. It's them spending some time on that iconic building in London, in the city, and being mentored by the managing agents in how insurance works for those type of products. And it's a win-win situation because they all learn from one another.
Whilst we're at the topic, what will be the European how will the European version complement and contrast the Lloyd's lab in London?
So what we want to do is keep exactly the same spirit, and I would say almost branding around the creation, but it would be more European in that you would have either more European capital in terms of funding, or more European founders, or solutions which would then really address the European market. So when we're talking about floods, for example, they have a different dynamic in Europe than what you would have, for example, in the UK or elsewhere in the world. So, and also in terms of where they would be, we would keep this a few weeks in London. But then we would like to have 1 or 2 places in Europe, say, for example, Munich, as we were talking about Munich earlier. And the last step could be in Brussels, because this is where we're based, and we could make sure that the Belgian government, for example, would be involved, because so when we had to select a place in Europe, Belgium was very welcoming, and we want to kind of give back to Belgium.
I would, before we go into what are you expecting at DIA in Munich in a couple of, well, actually 2 weeks, then people know when we take this recording, is we had this one question about sustainable insurance, or and intentionally used the German word enkelfähig, which basically means appropriate for our grandchildren, because I think it encapsulates the eco-social and the future aspect quite well. Would it be fair to say that you've given already at least a partial answer to that question, namely to bridge the protection gap and make sure that our society is prepared for what's going to happen with a world that is changed through climate change one way or another? Or is there some addition to that answer? Because I felt the answer was leading towards that already.
Absolutely. I think that there's an additional dimension which is very important, which is transition. So in an insurance company, you can act on 2 aspects. One is, because we collect lots of money, we invest a lot on behalf of the customers. So we are very influential in where we put our money. So we invest a lot in governments, the government bonds, corporate bonds, private equity securities. So where we put our money is key. And so where we withdraw our money is key too. So we can have a very significant influence in then stay in one given industry, provided that they have a transition plan, or we remove the money. And I remember one of my first actual course, the teacher was saying, actually, you think insurance is about providing a service and insuring your assets, but it's mainly an investor and in supporting the overall economy. So if you were mentioning AXA, it has a 900 trillion billion balance sheet. So it's massive. It's a lot of money. So if then insurers decide to withdraw that money from one given industry, then it's going to influence a lot what they can do or cannot do. So that's one way to influence people, investment side. And basically, keeping investing in those industries, providing that they have a transition plan. But that's the same on what we would call the liability side, where you can say, I'm going to continue to insure you, provided that you have a transition plan as well. And we could act, because, you know, if we think about those very large industries, we audit their facilities, their plants, to check, you know, that they would have sprinklers or things like that. And we can check in a similar way whether they are on track on their transition plan. And if not, then we could say, well, we're not going to insure you. So that's one additional way for insurance companies to be influential on climate change, for example, and sustainability.
I have one follow-on question. I was at a lecture yesterday by French economist Jean Tirole, who I didn't know before. I think he's reasonably famous in. He said he's the tomato economist in France, and he was also, I think, advising Emmanuel Macron, and he put an interesting emphasis on the investment side. And what he said was, actually, it's not entirely true. If an insurance company puts some money into an already existing wind farm, nothing happens. If the wind farm is already there, and no extra carbon emissions, nothing happens other than the insurance company extracting some growth from that wind farm. Now, you know, we can talk about what the opportunity cost of putting 100 there versus 100 there, but what he said is it needs to be additional. So insurance companies actually cannot just put their money in ESG, MCSI funds, but they need to fund new projects. That's actually what's going to drive it forward. So they need to. Is that your? And I was not aware of that prior to yesterday.
That's totally right.
Or become actually activist investors in best in class and drive Shell to just be a little bit less dirty. But it's counterintuitive. It is not investing in the Norway water plant. That is not what's going to have an impact on climate change. What is that a fair? Is he right? Or
I would still say it's a little bit of both, because still those wind farms need money. So we shouldn't underestimate that even those who already exist need funding. So I wouldn't underestimate that part, but certainly our role is also to foster innovation and invest where it's innovative. Having said that, and that's why I would still keep the idea of investing in in areas which are established, is that it's not our money, it's your money. So in all the investment, I was the other day we were walking.
But if BlackRock can do it, Amélie, if BlackRock can do it, so can Lloyds.
They can, but don't forget that we are highly regulated. And because the money, again, that we're investing is not ours, we need to have some security around those assets. I don't want to undermine that point, because when insurers, you know, ventured in subprime, and probably it was not also with this, I would say, sustainable goal for certain, then they were blamed because they played with the money of the policyholder. So I want to just say that and regulators, and the whole thing is that so we need to keep capital. You need to have capital, which is a bit counterintuitive, because in theory, it's financial services. You don't need to have capital to build a plan. So the three of us could create an insurance company with no capital in theory, and then we're going to collect money first. So we don't need to build anything, and then we're going to pay claims. But we need capital because we could be wrong on the premium computation. And that was my point around the law of large numbers. So we need a lot of capital, and that capital is going to depend in Solvency II, notably, on the assets that you're holding. So depending on how uncertain they are, and that's why I think that anyway, there'll be an envelope for innovation, but you still need to keep some, I would say, more prudent investment. But then, having said that, I think this is where the role of policymakers would be key, because what we are advocating is that we would be more than happy to invest in areas which are less certain, but because it's policyholders' money, then we should have a bit less of a capital requirement to back those investments. And this is where there's, again, another type of partnership, which is that, and we advocate the same for infrastructure, things which are very, very long term. We are more than happy to finance them, but we need here, again, a bit of a partnership between the two. So I think in that sense, he was right, because we have, the thing is, we have large investment teams, and they can scout the whole world. So it's very powerful. We should leverage this more, but there's a bit of a give and take on this one, because then we don't want to be taken into a place where, because those assets would be, those investments would be considered as being more risky, then we need to hold more capital, and then shareholders will not follow us. So that's the thing. And I'll just add another point about then the Lloyd's market. Is that so? AXA is on the Lloyd's market, Munich Re is on the Lloyd's market, SCOR as well. But a lot of the capital that is on the Lloyd's market is coming more from private equity, pension funds, because they have they are less sensitive to volatility and those and the volatility of those very large risks, as opposed to if you're an listed company. And this is where allowing for those types of things to have capital of very different types of investors who are looking at very long-term things, so like pension funds, they are not listed. Their risk is longevity. And so it diversifies away very well with our type of risk. So allowing for that to happen, I think is a great thing. So I think he was totally right. That's our role as an investor to probably take sometimes more risk, but with the caveat that I have a bunch of regulators look at what I'm doing with people's money, and rightly so. And it needs to be in a partnership that we agree to co-finance all those new areas.
But it's not only the regulators, it's mainly the shareholders. So if you, as a big, huge company, especially when you're stock listed, when you go beyond the normal stuff you do, take Danone or Unilever, you're just sent away, because your shareholders are short-term oriented. And if you talk about long-term risk and transition, it only can be done by legislation of the state. And it's the whole topic of Mariano Mazzucato, etc. And if you take all those enormous innovations, which is nowadays seen as invented by Elon Musk and other entrepreneurs, they are not. They are totally long-term funded research projects funded by tax money. It doesn't matter if it is defense innovation in the United States, or doesn't matter what it is. So as a CEO of a public listed company, you're just locked in the short-term optimization of your shareholders. And if we want to solve, or I mean solve between brackets, if we really want to deal with climate change and other big topics for our grandchildren, just to quote Nick again, then we really have to move forward, because we're just locked in our own decisions schemes.
So, unfortunately, well, not unfortunately, fortunately, this has just been a teaser for the DIA in Munich. And it's really good. We're 1 hour in and a bit, and I could just go on, right? Because, this has been fascinating, and I think we've touched a lot of things, but maybe to for now end this, Amélie, what is it that you are personally looking for at at DIA, and what type of conversations are you looking forward to?
So, first, I'm really looking forward to join DIA. I think it's going to be very exciting. So there's a bit of a give and take here as well. So I hope to learn a lot about innovation, what's out there, what are the insurtech and fintech thinking about, what are their pain points, how can we help them? Is it about money? Is it about ideas? Is it about brainstorming? Is it about understanding insurance better? So it's really about, I'm going there in listening mode, even though I've spoken a lot about the past hours. So so that's really understanding and learning about what their needs are, and a little bit about what our needs are. And we are talking about a platform and supply and demand, and it's how to meet those needs. So how can Lloyds support the development of those fintechs and insurtech, and how can we maybe influence them a bit on why don't you do this or why don't you do that? But after having listened to what they're up to, I'm kind of, so I'm 53 years old. I need a bit of reverse mentoring. I think I can bring a lot on my experience, but also I expect a lot from the more junior generation. And yeah, being a lot in a listening mode, even though I spoke a lot today.
That's great. And I can say, DIA is a great forum for that. And Tom and I looking forward to hit the ground there. Would love to at least just briefly say hello in person. And from my end, Tom, Amélie, unless you have anything else to say, I'd be happy to wrap this up.
Yeah, sure. Looking forward to seeing you in person in Munich.
Me too.
Awesome. Amélie, thank you so much for your time. Have some nice remaining 2 weeks, and see you in Munich. Take care.
See you in Munich. Thanks a lot. Have a great
Bye.
day.
Bye-bye.
Bye-bye.